going to be on 5 minutes before.
Sorry.
That's okay.
I just don't want people to hop off and think that we're not having the call.
Yep. Good afternoon, everyone. We will get started. Oh, and here comes our co-host. Perfect timing, Mr. Jaime Frederes. We will get started in just a few minutes. We're going to let a few additional people roll in here today. Your timing is good, my friend. I said your timing is good, my friend. I was beginning to get a little worried. Oh, you can't hear me?
I can hear you now. I'm sorry. I've got two different headsets depending which call I'm on.
I said your timing is good, my friend. I was beginning to get a little bit worried. I know you said you were on a tight schedule today, so appreciate you joining us. Good.
My pleasure.
Good afternoon, everyone. This is Faith Howard Mooney, VP of Member Engagement at the Mortgage Collaborative. And this is the last week in Mortgage Today. I have someone who is one of my favorite people to talk with. We don't get to talk often, but the last time that we did this show together was the first time I had ever done it. So I'm forever indebted to Mr. Jaime Frederes, who is the SVP of Residential Lending at Bar Bank and Trust. So Jaime, thanks for doing this with us again.
Oh, you're welcome. I've actually a little bit of history. That was my first time doing it too. So we were two first-timers doing it last time.
Yeah, at a conference. I remember I was at a conference in a hotel room. It could have been just kind of not great, but it was a great conversation. So I look forward to one that is much the same today. One of the things that is like, there are a couple of things that have kind of come out of the news, and it seems like everybody now all of a sudden is talking about them. If you are on LinkedIn at all, people in the audience, which I'm sure almost everybody is, you could not help but notice that last week was MBA Advocacy Week in Washington, D.C. It was just so awesome to see so many people that we know within the TMC family representing their states during Advocacy Week, and just seeing all the pictures of people getting together. And I know that you were supposed to be there, but didn't end up being there.
Yeah, actually, it's part of, besides being the director of residential lending for Bar Harbor and Trust, I'm actually a board of governors for New Hampshire mortgage bankers, and one of the leads in the legislative committee. So we were supposed to be, well, most of my team was there from mortgage bankers last week, but due to some family conflicts, I couldn't make it out there.
Yeah. So you want to, just before we get started, just so people, I mean, a lot of people within network know who you are, but just give a little teeny tiny synopsis of what your role is at Bar Harbor Bank and who Bar Harbor Bank and Trust is.
Sure, it'll be my pleasure. So Bar Harbor Bank and Trust, we are just under a $4 billion community bank based out of Bar Harbor, Maine, though my executive offices are in New Hampshire. Our footprint with 53 retail branch locations is in Maine, New Hampshire, Vermont. We have a wealth management, a large wealth management division, very prolific in the commercial lending space, as well as treasury and merchant services as well. I joined the bank actually 4 years ago this month to start to build out the residential lending platform. And I had the luck to roll into the refinance run of 2019 and then spin right into the pandemic. So, one would say that the work is just starting right now with some of the headwinds I'm sure we're going to talk about.
Yeah, absolutely. Absolutely. And I'm a 4-year person too. So I have, as of 4 days from now, I will have been at TMC for 4 years. So we kind of started in this endeavor at the same time. So that's pretty cool. But yeah, MBA Advocacy Week was last week. Couple of hot topics that came out of that. One of which has been published, I think, everywhere possible in the last week, was related to trigger leads.
Yeah. It was when I first got selected to do this, I was wondering, what are we going to talk about? Everyone's just over talking, and then right on the heels of MBA week and everything, there's a lot of emotion and passion around the trigger lead debate. And it's fascinating that the mortgage industry seems very united around it, keeping in mind that there are some lenders out there that really make their living off the trigger lead debate, but off the utilization of trigger leads. But this I had the opportunity to talk to a few of my colleagues and what was discussed with the trigger leads, and there's momentum around this. Really, the only major oppositions we see right now are the credit reporting groups themselves, who have a stake in offering the trigger leads. But I got to tell you, a lot of discussions are around the negativity around it in so many different buckets. First and foremost, as everyone on this call knows, margins are thin right now, and competitive factors are very difficult. And when mortgage bankers and mortgage lenders are gaining acceptance to move forward with a customer who's made a decision to move forward with them at a margin that is probably competitive, but certainly a lot thinner than it was a couple of years ago, to be just an onslaught of counter offers, eroding away at the offers that the original lender made, but confusing our customers. Never before has there been the access to information that the consumers have right now with the internet, with their banking. They are very well exposed to a lot of the options out there. I think there's a general consensus that the trigger leads are a challenge. I think that they're probably eroding a lot of the profits that go along with good competitive pricing, and creating a lot of confusion. And there seems to be a united front to really push on the trigger lead issue.
Yeah, I think that all of that so valid. Would love it if people would pop in to the chat experiences they've had. It's always interesting to hear about experiences that other people have had. I recently made a move. It was a quick move. So I got a bunch of solicitations and still continue to get them today, 2 months after, from people. And I can look at the envelope, and obviously I know it's a solicitation because I'm in this, business and have been in the business for a long period of time. But the offers that are being extended out there, I have to think that they're not real. So the other, the other piece of that, because I know what I got and I felt really comfortable with where I was at, but people offering me something in the sub fours does not seem like a real deal at this point in time. So it's kind of like it gives a very negative feel to it when you start, I was going to keep them all and pile them up to see how many I had. I didn't end up doing that. I ended up getting rid of the stack of them. But yeah, so I'd love to hear, from anybody who is on this call, experiences you had. And then, if you would share, maybe different people are going about this differently with their consumers, because it is something that consumers who don't go through this or don't experience this all the time aren't going to have the same knowledge that those of us in the industry have about what this all is. So would love if you would talk just a little bit about kind of what you're doing to educate your consumers that you're working with.
Yeah, I'm looking at some of the chats starting to come in here, and I think one of the things that is also an ancillary negativity is there's an implied breach of trust with your customer, because the first one they're looking at is you. It's not that the credit bureau sold that information. In layman's terms, our customer, who we've worked very hard, maybe an existing customer, a return customer, it's a big breach of trust in their eyes. And so that's a challenge for reputational risk as well in that space. We consistently talk about it, about educating the customer. It seems to run in spurts when we see a lot of these onslaughts of customers being attacked on here. But I would say our professional originators will let their customers know that we're going to be running your credit. Keep in mind the credit bureaus, some credit bureaus, we can't tell which ones or how it's going to happen, may sell your information. Just to know that this is not something that we're doing. It's something that's an ancillary effect. And we've tried different things too, let's leave the telephone number out of it, and they won't catch it. And I actually had a meeting with one of our credit reps from one of our credit reporting companies, and they said it's a good trick. Doesn't work all the time because the analytics will put the number in there. And I won't say I haven't been above putting one of my competitors' cell phone numbers in real quick and say, okay, let's have them call one of my competitors, all those trigger leads. And so there's a lot of different things you can try, but it really is putting an additional burden on the sales process, margins, and we're looking at having to change our systems just to protect our customers, and not only their perceived privacy, but also our business model and sales cycle.
Yeah. There are great comments in here. Thanks everybody for hopping in the chat and putting some stuff in here. Kelly, it sounds like you've tried the same thing that Jaime and his group has had with the phone numbers. It worked for a little bit, but then poof was the comment that poof, it didn't work anymore. Melissa posed a question out to the group. Is anyone approving customers on soft pull and then doing hard pull right before CDC? So I would assume that probably a lot of people within this group are looking at that soft pull option, as well as opt out information out to the consumer. That's kind of what we've heard internally within the TMC family.
It was interesting. One of the consumer groups that opined on one of the articles was indicating that basically, as an advocate for trigger leads, also indicated, well, there's different defensive strategies you can take to prevent this from happening, which I found very ironic. That, okay, we're for them, and for you to go apply for a mortgage, you should do defensive things, so we just don't crush you with phone calls. I think there's momentum around this, and I'm hoping that all of the groups who are supportive of the legislation to change it don't take their foot off the gas, because it's creating a lot of confusion. It's creating a lot of challenges for the lenders and the customers and the relationships they're building with their customer base.
And we've been hearing about it for, gosh, at least a month to 6 weeks within our network of people. But it does seem like all of a sudden other people are talking about it. Consumers themselves are talking about it. So I think, the timing is to put your foot still on the gas a little bit.
Well, you take a look at the market. You take a look at the market and the significant reduction in mortgage total capture opportunity, higher rates, payoffs are at industry lows, historical lows. So there are a lot of different companies that are looking for solutions to continue to maintain their existence in the mortgage industry. So it's not a surprise that we're seeing a pickup in the trigger leads as everyone's searching, how do we capture a bigger piece of a smaller pie right now?
Right. Other hot topic out of DC, which is one that won't surprise this network at all because it's been talked about many times, are the LLPAs related to DTI. And that one, again, I would say it does appear, although they're looming now, they're getting closer, it does appear that people are listening. So would kind of love your take with that coming up relatively quickly. Would love to get your take on that as well.
Yeah, this has been a hot topic for a couple different things. One, I think the elephant in the room is the DTI, suspension of the DTI LLPA, but with the looming return of it. But it was interesting because I've had more calls on this topic over the last week to 2 weeks, partly because the news just figured out what's going on. So I think it was one or two of my originators had sent me articles early last week, or maybe it was the end of the week before, saying, hey, this Biden plan, this is, what do you think? What do you think? And, are we going to do it? And I'm like, we've been doing it. It's the media has picked up on the fact and focused on the implementation on the settlement, the contract settlements with Fannie and Freddie, as making that current news, when in reality, a lot of the credit score LLP ratings and increases went in about 60 to 75 days ago. But the hottest topic right now is the DTI, and I've been doing a lot of reading on this, independent of spending time with the group right here, because there are a lot of people looking for answers on this, and I think there's a popular consensus, and there's a lot of pressure. Actually, you shared with me earlier today a letter that TMC and some of their members sent out. I read a letter that was sent by a National Association of Realtors. I've seen a lot of debates on this. I think David Stevens was on CNBC yesterday morning talking about it as well. I think that there is I think there was a move to try to increase affordable lending. And that's not a bad idea. But I think the delivery and how we're doing it was probably look better on the whiteboard than actually in play right now. There's not a person on this phone who doesn't feel protective of their customer, that doesn't want them to experience that. But you take a look at the perfect storm we have right now. I mean, we've got high interest rates, we've got high values, taxes going up. The cost of owning a home has gone up significantly. The same borrower that we may have done a purchase for, 3-4 months ago, or 3 years ago, they bought the same home now. If it was a static market, the cost of borrowing is even higher. And so there's certainly a lot of argument here that putting this in where everyone's heart was in the right place, there's a lot of execution problems on it as well. On top of that, putting a hard static number on a DTI goes against what CFPB and qualified mortgages have been doing. It wasn't less than a year ago that the regulators took out the definition of a hard stop on a qualified mortgage at 43. So they started the move getting away from a hard number to define what's a risky loan, but they come in behind it and put a hard number on where they're going to put a price increase in there. So, I think there's a lot of strong momentum. I think there's a lot of hope. I think there's a lot of people who will be looking for more definition in the next 30 days from FHFA if this is really going to stick.
Yeah, because the time frame is relatively short. There are some comments in the chat. Jamie, yeah, they kicked it to August, but further conversation is still being had. I think the hopes of people is that they will pull the plug on them, whether that's reality or not. No one really, if we knew that, we probably wouldn't be here. we would be doing something different. But yeah, the time has kind of come to where people are going to have to start thinking about implementation of things within their process in order to meet that August timeframe.
Yeah, and this is not even taking into account the additional stress from a compliance standpoint and a regulation standpoint. Going back and retraining your LOs, taking better quality upfront apps, understand your customers before you can quote price. There's been so many different layers of LLPAs in there. So not that it's a bad thing. Continue to coach loan officers, taking better quality apps and more complete apps and knowing your customer. But, you can get into now definitions during audits, in high volume times, we may take the ownership of a tax return, but because of processing timelines, we don't get to it for a week. Well, when do we have knowledge? Well, we took ownership of it. We just didn't get a chance to take a look at it. Does that still fall under the 3-day valid change circumstance? We don't know. Those are a lot of the challenges that we see with the DTI implementation.
Yep, lots of operational challenges there for sure. Kevin Piranio, we absolutely love you. I love your comment that it's just annoying, not the DTIs, but talking about the trigger leads. I won't read the rest of the comment, but everybody
goes. I saw that. I saw that one too, and I remember. If you've ever been scuba diving, you see these big fish, and then you see the little fish sucking onto the bottom of it, the parasite fish, and you can't help but get that out of your mind. And I may not be invited back based on that example, but kind of coming in behind Kevin's comment there.
Yeah, I think a lot of people are feeling that. And Ira, you're exactly right. It'll be hitting rate sheets any day now. If you're talking about a 75-day lock, if you have a 75-day lock, you're getting pretty close to that 8/1 deadline. That is very valid. So I think that is top of mind is because of that. And KP agrees that DTI is annoying too. It's both of them, both of the topics, not just one.
I'm starting to feel like one of those talk show hosts that gets the audience all gamed up here. So,
are you the hype man? Yeah. So let's move on. Different topic. In a world that I used to reside in, so would love your opinion. MBA came out with an amicus brief. The headline was "Lenders Not Liable for Actions of Independent Appraisers." So looking at appraisal bias and some other things within appraisal. So let's talk about appraisal for a little while. I know you have an opportunity to read that information. So kind of share with me, you know, how you feel about what's going on in the appraisal world right now.
Yeah, that you're going to have to invite me back for 2 or 3 of these calls if we're going to try to tackle all the appraisal stuff. You know, you take a look at the whole lending process. Probably the last segment of lending that hasn't been overhauled is the valuation of our subject property, of the collateral. And, you know, there's been, you know, we've got some new forms, we've got some new ways to take a look at it, but it is one of the areas that still needs a lot of attention. And that really blossomed during the pandemic about different ways to appraise properties. You know, the backlogs were creating, you know, financial stress on contracts and on people and everything. But, you know, there is so much subjectiveness and there's so many challenges in the appraisal process right now. In fact, I'll give you a good case in point. We had a transaction about a year and a half ago, someone doing a new construction loan with us. It was about a 3.1 million contract, land and building costs. And because of the amount that we were lending, we had to do 2 appraisals. So we sent 2 separate independent appraisers out from 2 different firms so that we could, you know, get a better understanding of the property. We had one appraiser come in at 3.1 million, nailed it right on the top, right, hit the number perfectly. And we had one hit at about just over $2 million. And so I've sent 2 appraisers out. I've gotten $1 million delta on a $3 million. Now, we went through our appraisal due diligence. And here's the thing, as a standalone, they were both right. The comps, you know, both appraisers used comps in the neighborhoods and justified their value. And you know, we were stuck at that point, which is just goes to show that, you know, the lack of analytics, the lack of subjectiveness in the appraisal industry right now. And I've talked to a lot of appraisers, and they're feeling the challenges as well, especially with the run up in prices through the pandemic. And, you know, now we're starting to see a softening is where they're going. So one, I think, you know, the appraisal industry needs to take a look at, you know, how do we come up with better, consistent models to value property so that the lenders feel confident using that the property as collateral and that their loans are secured. That's number one. Number two, during Dodd-Frank and all the ensuing legislation, one of the things that was adamant is for the banks to distance themselves from the appraisal group. Yeah, don't talk to them, don't look at them. You can't play golf with them anymore. You know, and so I think the industry's done a great job at that. So to come back and say, okay, we're going to hold you responsible for that. I'm supportive of the brief that the MBA had written on that, and I think that's going to get a lot more momentum because there are challenges to create legislation and regulations to distance yourself from the appraiser, but then to come back and say, hey, you're going to now be accountable for someone that you're distanced from. The two don't go together real smooth.
Especially when appraisers they're neither an employee, they're not an employee of the company. They're also not an agent of the lender member as well. So they're neither of those things. I would be curious if people could pop into the chat on the repurchases that you're seeing. Are you being held responsible for things in the appraisal? Because that used to be kind of a standard practice that the lender was always named in those. Yep, there's chat already, so I know that that's true. There are some people in the industry that are doing some unique things related to other types of valuations. There are some, there aren't a lot. And a lot of lender members have built their panel of appraisers around people that do a traditional appraisal. My experience in managing a panel of 7,000 appraisers across the United States was there were kind of like 2 distinct differences. There were appraisers that were more traditional that wanted to set up an inspection, needed to see the inside of the home, and wanted to do a full appraisal. There was a whole other group of individuals that were very comfortable with more of the technology play, viewing things, you know, in photos that were recent but not taken themselves, and would do other alternative types of valuations. In your market, I mean, do you experience any of those alternatives? You still seem primarily full appraisal opportunity.
You know, one of the reasons I moved to northern New England, out of New York and such, is because I wanted a little quieter lifestyle, you know, and I like the seclusion of New Hampshire, Maine, and Vermont. So we are challenged up in our marketplaces. I'm sure some other lenders, both in our markets, maybe on the call and other areas, that some of the data analytics for appraisal waivers and for AVMs, there's such a uniqueness to the property stock out here, and or the lack of data due to the heavy concentration of community banks, maybe things not being sold into secondary market. That some of the AVM hits the appraisal waiver hits through the GSCs, our hit rates are very low. So we do have to rely on more of a traditional appraisal approach than some of the metropolitan areas across the United States. You know, when Freddie and Fannie came out with the exterior only, but it sounded, once again, sounded great in the whiteboard, right? Like, okay, problem fixed. Though you have to have a detailed drawing of the interior of the house, you know, and if you can't get it, then you got to go inside. So, you know, once again, you know, due to, you know, the aging housing stock in northern New England, we didn't feel that the lift from some of the initial appraisal changes by the GSCs up in northern New England.
You also, in an exterior only, you think lesser work, lesser cost, but I don't know as I think that plays out in the appraisal world as well, because they feel like they have the same amount of liability for either one. So they're not going to necessarily discount the fee that they would get for those as well. So it's like, then what is the upside? Do you get it a day sooner?
Yeah, they're still going to the house. They're still taking the pictures. They're still doing the data on the computers. So, I mean, you're really saving probably 20 minutes of inside if that were to happen. And I think it's important to note too, this is not, you know, I shouldn't say this as a universal statement, but I don't look at this, and I hope the rest of our groups don't look at this as pointing our fingers at the appraisers. It's the valuation models and the methods that they have to, and we have to supply back to the purchasers of the loans as far as proving the valuation of and condition of the property.
Yeah, it's what they need to comply with for them to maintain their licensure and you know, be a responsible party in the transaction as well. Eric, appreciate the comments in the chat. Value assessment versus an appraisal, give a lower and upper kind of boundary instead of, you know, instead of having the value is X, is one thought process definitely out there. Additional feedback from Cali that most of their appraisers were charging the same thing, so they just went with the traditional. They're in a Kansas market. So maybe a more similar market to you. It's not, I mean, here in the Twin Cities, we do have some developments that are kind of standard development, plain vanilla, where maybe, you know, an exterior or something like that plays out a little bit better. It's a little bit easier to accomplish.
Holding the lenders accountable for the appraisers and liable for the appraisals. It just reminds you back in the 90s, and I can't quote the legislation, but I think it happened out of Baltimore, where legislation was passed that correspondent or the end owners of the mortgage were going to be held responsible for the representations that the brokers who originated the mortgage for. And you know, I can't remember the exact legislation, but I do remember going through that, where there was a big pullback and a contraction of credit and the availability of credit for those people to lend, because until there was due diligence on that, you know, how could they be responsible when they didn't have any customer contact? This just reminds me of that happened in the 90s.
Yep, it is, and I can't believe it, but we are at the end of a half an hour. I'm not quite sure how that always happens. It goes by so quickly, but appreciate your comment and all the comments in the chat. We absolutely positively love it. Then what that happens, leave you with one additional thing for those of you that want to get involved in advocacy, any of those things, and you want to have an opinion. FHFA issued a notice of proposed rulemaking for fair lending this last week as well. They are looking for comments. Yep, comments on the proposed rule within 60 days of the publication of it. So if you're someone who likes to provide that feedback, I know we have a lot within the TMC family that do. They are looking for it, and it does appear that people are listening to the things that you guys are saying right now. So I would encourage you to go out there and give some information back to the FHFA. Jaime Frederes, it is always a pleasure to have you on this call. No need to worry about whether you'll be invited back again.
I feel like it's, listen, I enjoy giving back. I enjoyed the relationship with TMC and my colleagues there, and I welcome the opportunity to come back again. But to your point too, I think stay involved. If you're passionate about it, don't keep it to yourself. And through your local MBA, through TMC, I think there's great momentum on some of the pain points, and I think it's incumbent on every one of us as in the industry to keep the momentum up, because I think we can make some differences and some changes.
Agree, and appreciate you all. Appreciate all that you joined. If you're listening to this in our podcast environment, please join us and share in the chat with us sometime soon. Appreciate you, Jaime. Thanks so much for doing this.
Okay, thank you.
Have a great day.